Good morning, everyone. Welcome to our this week's research morning call. Today we have quite a lot of stock counters that we need to cover, as well as our Magnificent Seven, SG Banking Monthly, and our usual SG Weekly and technical analysis. So without further ado, I'll pass my time to John to start the ball rolling.
Thanks, Helena, and good morning, everyone. So I'll just start with Phillip on the ground for Grab Holdings Limited. Next slide. Yeah, so just to clarify, we don't cover Grab, so it's not rated. We're just running through their second quarter results. Overall, Grab had a pretty decent quarter. There was growth across all segments, while net loss continued to narrow and profitability continued to increase. At the same time, a lot of its key user metrics improved as well. So that's users, volume, as well as transactions. The biggest reasons, and you can see this in bold, the biggest reasons is because they introduced quite a number of new affordable products like Saver, etc. And these lower cost products, at least lower cost of the consumer, drove more transactions and more users to actually use Grab versus some of these other competing platforms. The downside for this is that because they are, I guess, slightly cheaper products, the margin profile is lower compared to its just standard or premium selections. So it in some sense it is low margin, but on the other sense, kind of have a higher volume, so it kind of makes up for the deficiencies in margin on absolute value. The big thing for Grab is that they actually launched their digital bank in Indonesia, which is called Superbank, where they managed to get about 1 million customers after launching for like less than 2 months. The financial services or segment continues to grow, and this is essentially a digital bank. Customers continue to increase, deposits continue to increase. Although for right now, this is still kind of a negative because they don't really have any that many big products that they can generate significant revenue from. So a lot of these deposits are just paying out interest to customers. So it's very attractive for consumers, but in terms of business model for now, at least, not so much for the business. In terms of the outlook, the revenue guidance and adjusted EBITDA guidance remain unchanged, although Grab did mention that they're a little bit more confident in reaching the upper ranges. So for revenue guidance, it's actually 13 to 17% year-on-year growth, and adjusted EBITDA close to $270 million. The big thing for them is that towards currently in the second half of 2024, as the US dollar continues to weaken, it's actually a positive for Grab. In the first half, currency was about a 5% a headwind to growth because the US dollar continues to strengthen. But in the second half, this should improve because it is weakening. So overall, results are pretty good. The downside is that the market didn't really reward its performance because when you compare Grab versus, the main mobile platform app is Uber. Right? Grab is actually growing slightly slower and less volume, even though they are supposedly faster growing because of its smaller scale, and it's in a very where Grab operates is in highly populated developing countries like Indonesia, Philippines, Vietnam, etc. The big knock is that the monetization is still kind of a question mark because they're not able to monetize as well as Uber. For example, their take rates for deliveries and mobilities are almost half of what Uber can get on its platform. So those kind of remain kind of the question marks, and that's why the stock price didn't really move that much. In fact, the stock actually went down a little bit after their earnings. Yeah, so overall, decent results for Grab. It's just still question marks around profitability, whether they can leverage and monetize a little bit better. Yeah. So that's all for Grab. I'll move on to the Magnificent Seven. Yeah, overall performance was pretty poor in July. The Max 7 was down 2.3%. You can see in the chart, most of the companies were down. Only Apple and Tesla were positive. Um, and the Max 7 lagged the S&P 500 and NASDAQ both. Tesla was the biggest gainer, mainly because of increased. Well, firstly, they beat the deliveries estimates for the second quarter. And secondly, there was this kind of follow-through positive reaction towards FSD approval in China. Microsoft was the biggest laggard, down 6.4%. So you can see most of them like Meta, Nvidia, Alphabet, they're all kind of roughly around there, 5 to 6% declines. We saw quite a bit of profit taking pre and post earnings. So these results don't take into account post earnings for Apple, Amazon, as well as Alphabet. Oh, sorry, Microsoft. Yeah, and another big concern is actually there's a lot of concerns over the return rate of return for AI, the kind of AI investments that a lot of the big tech guys are making. Next slide, please. Yeah, so we've just run through the result summary for most of the companies for the quarter ending June. Most Max 7 companies beat or came in line with revenue as well as earnings estimates. Only Tesla missed bottom line, mainly due to continued margin compression and some lower volumes as well as lower pricing. The caveat here is that growth expectations for Apple and Tesla were not high. The expectation for Apple was basically low single-digit growth. Tesla was actually a low single-digit decline. So it's not really, even though they did beat expectations, the expectations were so low that it's kind of almost impossible to not beat. When you look at the individual companies, digital ad companies were the fastest growing. Google and Meta, they were expanding 20% essentially year on year. Thanks to a recovering digital advertising industry, they were able to, prices were actually increasing for ads. This was kind of helped by a little bit by AI driving a lot of efficiencies in advertising performance. Microsoft results were supported by a 50% year-on-year increase in Azure, which is its cloud segment. While e-commerce spending, resilient e-commerce spending was actually boosting Amazon's results as well, although they did have a benefit from AWS, which was up almost 20%. Apple actually didn't see any iPhone growth, or rather demand wasn't really supported by iPhones, but rather from its services. We expect this to continue, especially with demand for iPhones, even the new iPhones, remaining fairly soft, especially in China. There was estimates that were toned down for the new launch because they didn't really see this refresh cycle happening so soon, and pushed it back into 2025 instead. Tesla just disappointed all around because, like I mentioned earlier, volume and pricing came down, intense competition in China, and just generally there's a little bit of a waning in demand for EVs. Guidance for all companies were roughly similar in terms of growth to second quarter, so about 10% year-on-year growth. Although it was worth noting that we are entering a period of tougher comparisons for most of the digital advertising companies, because in the second half of last year they saw very strong uptick in outbound Chinese advertisers trying to get non-domestic, revenue onto their platforms. Next slide, please. Yeah, so we'll just briefly talk about the ROI on CapEx. This big issue about hyperscalers just continue to pile money developing AI software, AI programs, and all that AI infrastructure. The big worry is, like I mentioned earlier, the potential rate of return for CapEx spending. So we just did a kind of a very back of the envelope estimates and try to find out how much AI revenue is required to pay back. We use NVIDIA's data center revenue as kind of a proxy for how much hyperscalers are plowing into AI, because they represent about 85 to 90% of the market. And the assumption here is that NVIDIA GPUs are roughly about 50% of the total cost of AI data centers. So what we found is that the implied revenue required to pay back investments based on this year's estimates, were about $560 billion, which represents about 2.5 years of cloud revenue, and even longer for AI software companies, because they don't really make as much as a lot of these hyperscalers. But something that we thought was interesting is that when you look at just CapEx spending, right now it represents about 30% of cash flow from operations on a trailing 12 months basis. So we expect this to climb a little bit, but it's still kind of below the pandemic peak of 33%. Our view is that the hyperscalers are actually still very wary of overspending. They also understand that they can't really spend too much on that. I guess they can't really spend over the budget for what they have right now. Even though the commentary has come up, from a lot of the CEOs saying that it's better to overspend now than underspend. I think the worry is that if they spend too much, they fall into negative cash flow that will really significantly impact the stock prices. But the positive is that a lot of these companies are actually generating and growing their free cash flow, or even cash flow from ops quite significantly. So they have enough cash reserve to invest into AI and AI infrastructure especially. Next slide, please. So not really too many updates other than earnings. The biggest one for all the companies, at least for Alphabet and for Apple, is that Alphabet actually Google actually lost an antitrust case over where it places its search on Apple phones, not so much Androids, but mainly Apple smartphones. So what happens is that actually Google pays Apple about $20 billion a year to place their search bar or Chrome or whatever onto the front pages of Apple's phone. This is deemed to be by the DOJ to be sort of an antitrust, anti-monopolistic practice. So essentially they kind of banned it. So how this impacts Apple is that, rather how this impacts Alphabet is that it doesn't really impact them. In fact, it just saves them $20 billion. How it impacts Apple is that Apple loses this $20 billion in just pure profit, because it's just free money from Alphabet. And this $20 billion represents about 20% of its overall profits. On the flip side, Microsoft CEO actually came out to say that they will spend $15 billion on these kind of arrangements. So if Google search really becomes if this kind of arrangement for Google is banned, then likely you'll see Microsoft take its place with its Bing solution, and then Apple will at least recoup about $15 billion instead of losing the whole $20 billion. So net just a 5% decline in profits, better than 20%. So that's all for the real news for all of the Mag 7. We remain overweight. We still think that earnings results were quite very strong for most of the Mag 7. And most of there's still a recovery in the digital ad industry, cloud especially, as companies continue to shift to on-premise. Plus, we're seeing a lot of AI tools attracting new customers. iPhone demand remains fairly weak, while EV volumes and pricing are still suppressed due to increasing competition. So that's all for me. I hand it over to Helena for CDL. Thank you.
Thank you, John. So C also released their earnings last week. Their second quarter revenue was slightly above expectation, 23% year-on-year growth. It was primarily driven by their strength in Shopee, which grew 34% year-on-year. Their PMI missed on the 57% year-on-year jump in sales and marketing spending. Look at the entire first half. Their revenue and PMI was at 49% and 9% of our FY24 estimate. We expect the PMI to be backlogged into the second half of FY24 as the ramp-up of Shopee continues, and also because they have this gaming revenue that was late recognized, so that we expect it to come in the second half of the year. Moving on to the positive point, still very strong growth in Shopee. Their gross order and GMV both grows at 40% and 29% year-on-year. There have also been an industry trend towards higher take rate. Shopee itself is also putting in a lot of effort to boost its advertisement take rate, and they plan to accelerate this in the coming quarters further. They're also trying to enhance their logistic capabilities, so all these things add up together. Pretty strong growth for Shopee. In terms of their gaming user trend also remain really optimistic. Bookings were up 21% year-on-year. QAU, QPU both up 19%, 22% year-on-year. Free Fire is still primarily driving this growth. They already reached a scale where they have more than 100 million daily active users throughout the entire second quarter of FY24. But if you look at their revenue, it still dipped 17%. That's not because they're not doing well. It's mainly resulting from the GAAP treatment. So more of the revenue, they're actually going to defer it into the fourth quarter. So we do expect their second half revenue to grow about mid-20% as the positive user trend of FY24 gets fully reflected in the revenue. Moving on to the negative point, we're still seeing very high sales and marketing spend. C has actually been heavily spending on sales and marketing for the past 3 quarters in order to fend up the competition. So the spending still remains high, 57% year-on-year increase, and seems to have already appeared to be the norm for the company. It's unlikely that C will be able to reduce its sales and marketing expense to its previous level anymore. Moving on to outlook, C has pretty positive guidance. They have guided for positive EBITDA for Shopee and has raised its FY24 GMV growth rate guidance from high teens to mid-20s. So overall, we still maintain a neutral rating. We raised our FY24 revenue and PATMI by 1%, respectively, to account for higher e-commerce growth. Our DCF target price is raised to $80, slightly up from the previous $75. Within the company's triple-sided growth in C-Money, Shopee, and gaming, they do show potential to deliver return for the long-term growth. But however, if you take at a shorter term, it still remains challenged by the competition because C currently needs to maintain its very high sales and marketing expenses in order to keep the market share. That's all from me. I'll pass my time to Glenn for Singapore banking.
Hey, thanks, Helena. Yeah, for the Banking Monthly, we'll just do a quick recap on the 3 banks' second quarter results. So overall, it was slightly above expectations, mainly due to this fee income growth that we have seen. Fee income grew on average 18% year-on-year, mainly due to this continued rise in the wealth management as there was this shift from fixed deposits and deposits into investment and wealth management products, which benefited the fee income. I think if you look at the net interest margins and net interest income, there was a slight dip in net interest margins for all 3 banks, and this is to be expected as they are now continually moving their excess deposits, right? Instead of pushing into loans, they are putting it into longer tenure asset yielding interest assets. So this will give them a better forecast into the future and how their NIMs will be like, but also at the same time being interest income accretive. So, but then it will also reduce their NIM slightly, which is why their NIM took a hit. But if you look at the net interest income, it rose slightly on average. For fees and commissions, it was a good increase for all 3 banks. And this, as I mentioned earlier, came from this shift in investor sentiment into more wealth and investment products. For the PATMI wise, there was also a slight increase for most of the banks. I think going ahead into the rest of the year, I think we should see this continued move into fee income and a focus into fee income as well as especially the wealth management side. And their net interest margins and net interest income shouldn't increase, but shouldn't also dip too much. And I think it will be pretty flat going into the rest of the year. Okay, so that's all for the bank's outlook. I'll now head over to the interest rates. I think there was also a question in the chat that's asking about the outlook for the banks with the rate cuts. So I will be going through this as well just to answer that question early. For the interest rates wise, it was quite flat. I mean, it dipped 3 basis points month on month, but it's been hovering around this 3.6% range for quite a number of months already. I think it's really just Singapore interest rates do follow the US Fed rates. So we can see that if you look at the orange line and the red line, right, they are really quite in sync. With the impending rate cuts, this should go down once the rate cuts do kick in. So for the HIBOR, it's been doing its own thing. So it was down 6 basis points and just also around this range. So it hasn't moved really much as well. I think moving ahead, we could see in the second half of the year that the Singapore interest rates will probably take a hit. Now moving to the next slide. Yeah, for loans growth wise, it's back to positive after seeing a slight decline the previous month. This came from the consumer loans, which grew quite decently by 1.6%, whereas business loans is relatively flat, I would say. Business building and construction segment was the one that dipped, and as well as the manufacturing segment. Moving ahead into the rest of the year, this loans growth should increase and should continue being positive. This is a good sign because we are seeing loans growth 3 out of the last 4 months, it was positive. Although interest rates have still remained quite high and the rate cuts haven't kicked in, but we have seen loans growth return to positivity. With the rate cuts coming and the rate cuts, if the rate cuts do come in, then I think we could see a low single digit or even a mid single digit for loans growth. It will be mostly coming, I think, from the consumer loan side, which has shown good strength, especially the housing loans, which was really the only segment that was positive for the last year and a half. For the deposits and balances, it continued to grow. This was mainly due to this shift to fixed deposits. And the current account, savings account has also just been quite flat at this 18% range for the last year or so. So now moving to the Hong Kong side, Hong Kong loans growth has also been in this steady decline ever since the last 1 or 2 years, and I don't think it's going to be any improvement now with what's happening with Hong Kong as well as Greater China. Now moving on to the next slide. Now for the SGX market statistics for the SDAV, it was improved. It improved by 14% year on year. And as well, SDAV stands for the Securities Derivatives Daily Average Volume, sorry. As for the DDAV, it was also up, the Derivatives Daily Average Volume, by 7% year on year. As for the top 4 equity index futures turnover, it was, I think, relatively flat. It only grew 2% year on year. The interesting part will be the VIX, because the VIX averaged 14.4. This is higher than the previous month's 12.7. But I think we could see a sharp increase, and to expect this sharp increase going into the full month of August, mainly due to the carry trade and what happened with that, where the VIX actually shot up extremely high. So that's something to look out for in August. Now for the next slide, for the bank's performance, the local bank's share price performance was positive in July. All did rise for the month of July. UOB performed the best at 3%, whereas the other two, DBS and OCBC, are 1% and 2% respectively. If you look at year to date, DBS was still the best performer, 21%, compared to 14% for the other two banks, mainly due to their dividend guidance being the highest, as well as their dividend payout ratio. They don't really have a cap at 50%, and their policy and guide and their forecast for dividend payments is also the highest. But UOB did perform slightly better this month, in July, mainly due to them having the least proportion of loans and income coming from Greater China or Hong Kong. And that's the reason why probably people slightly moved away from OCBC and DBS to UOB if they want to sort of diversify out of this Hong Kong, Greater China, but still want to be in the Singapore banking side. So that's for the for the performance. Now, to conclude, and also to answer that question, we do maintain overweight on the banking sector, and we do remain positive. That's for the next slide. Yeah, and the NIMs we believe that the NIMs or net interest margins will dip slightly going to the second half of the year, and this is mainly coming from the expected rate cuts. But we still do expect that the net interest income will remain stable from the movement of excess deposits that the bank have into longer tenors, as well as higher interest yielding assets. And the recovery in loan growth, as well as the continued double-digit fee income growth, will uplift profits for the banks. And the bank dividend yields are also attractive at 6.1%, with upside surprises due to excess capital ratios, as well as a push towards higher ROEs. Now moving on to the next segment, the next slide I have, which is the UOB. So UOB, this is more of an update. They did their corporate day, or you would think of it as an investor day, held in Kuala Lumpur in Malaysia on 14 August. And I did go for this for this event, and we did have some key takeaways from their corporate day. I think the main ones, I won't go through every single thing because that's almost I think an 8-hour event. But the main highlights, and points that we look at was that their guidance, they did guide for a ROE of 14%, which will be sustained until, or it will be sustained till 2026. So 3 things how they will sustain this ROE of 14%. It's to maintain their cost to income ratio, or CIR, at 40% by 2026. And I will talk more on this later. So the second point is that they will have higher contribution from their ASEAN 4 countries. ASEAN 4 countries being Indonesia, Malaysia, Thailand, and Vietnam, to 30% by 2026. Currently, it's at 26%. So they're really concentrating on these ASEAN 4 countries because they did do this very big acquisition, the Citibank assets in these 4 countries. Hence, now they have this sort of accelerator to bring them to grow even further. What the CFO mentioned was that they accelerated their growth in these 4 countries by 5 to 10 years. So if they had to do it organically, it would have taken them anywhere from 5 to 10 years. So now they're doing it in almost, I think, less than 2 years to achieve this growth. So 30%, they're going to shift a lot of their focus away from Singapore, which they are predominantly into these 4 countries to further grow and to boost their earnings. And lastly, they're also looking at a higher mix of non-interest income as compared to net interest income. And this will be aided by their growth in wealth, trade, and customer treasury income. So they're looking at other aspects of the bank, right? They're not really concentrating on this net interest income and net interest margins because they know that the rate cuts are coming soon. So they are not looking at that to grow the bank anymore, but looking at the wealth side and trade as well as customer treasury income. Now, the second point, and I think that was the one that was in the news, was that they are going to offshore their cost to maintain their cost to income ratio of 40%. They have already started offshoring their operations several years ago, but now they are more like accelerating this offshoring to aim, and they're also aiming to centralize their card centers. Their first phase of offshoring will continue to be in KL, and they already have this sort of investment hub 2, which they call, in KL. Investment hub 1 is in Singapore, right? So investment hub 2 in KL. And I think what the CFO mentioned is that there's almost, I think, 40 to 50% cost savings if you hire a tech person through this innovation hub, in KL, in Malaysia, rather compared to Singapore. So they're saving quite a bit. And not only the tech side that they're moving into Malaysia, they're also looking to offshore some of their back and middle office functions. But of course, they need to look at the quality as well to ensure that the staff that they're getting in Malaysia is just as good or better than the ones in Singapore, but of course at a lower cost. So that's the main things I think they're looking at, to trying to lower their costs to ensure that it is at this 40%. And last but not least, they're also assuming 10 rate cuts by 2026, and that they will watch out for recent market volatility as well as the risk of US recession for any changes to this forecast. So while their margins will be affected, but the growth in the loan volumes as well as fee income will more than offset this decline. And also, the interesting thing is that the CFO said that the pressures on the exchange rates in the ASEAN will be reduced, and the ASEAN economies which have not hiked rates significantly now can reduce it further. So we do upgrade to a buy with an unchanged target price of $34.90, but this is mainly due to the UOB's recent share price performance. And we believe that they will be able to maintain their net interest income and net interest margins by cutting deposit costs, as well as continuing to increase their loan margins. And other tailwinds include loan growth recovery from rate cuts in the second half of the year and double-digit fee income growth, which will boost earnings. So that's all I have for the banking side. I'll now hand it over to Darren for the REITs. Thank you.
Yeah, thanks, Glenn. Yeah, so I'll talk about Prime US REIT's first half results. So the title is basically the refinancing finally complete. So that is the biggest positive for them. So looking into the first half results, the results were in line with our expectations. So the gross revenue is down. That's mainly due to occupancy decline as well as the AEI that's ongoing at One Washington Center. So One Washington Center now is about 33% occupied after Sodexo left at the start of the year. So as a result, their DI also fell by 20% as a result of higher finance costs as well. But this first half they are expecting, or rather they are going to pay out 10%, around 10% of their distributable income. So that is about 0.18 cents. And that is about roughly translate into a yield of about 2% of if we just annualize it. Yeah, so they are retaining this the 90% is they're going to retain it to fund capex and pay down borrowings. So this is compared to the other, I mean, this is slightly better compared to the other two US REITs who are not paying any dividends at all. So for this quarter, we saw portfolio occupancy dip slightly. Yeah, but for the positives, they managed to complete the major refinancing exercise. So this new facility is a new one. So it consists of a $400 million term loan and $150 million revolving credit facility that they can draw down anytime they want. So this new facility has an expiry, or rather matures in July 2026. So that is a 2-year maturity. And they have an option to extend this maturity 1 more year at a small fee. And right now, their all-in cost of debt is about 4.2%. So after they refinance this loan, we expect it to remain below 5% because right now already 330 million has already been previously hedged. But next year, we expect the cost of debt to rise to about 5% because right now the 3-month SOFR is already 5.5-ish%. So if you plus the margin, you get like 6, 7, or even 8% interest rate. So we expect the all-in cost of debt to increase. So another positive for them is that they managed to complete the strategic sale of One Town Center earlier this quarter. So they managed to sell it at only a 3% discount valuation. So this is a huge positive because right now in the US, the banks are still not lending any US office. So they are not financing. So any purchases are pure equity. And in spite of the very challenging conditions, like transaction volumes are low, the bid-ask spreads are also very high. They managed to sell it at only a 3% discount valuation. But if you compare it to the purchase price back then, in 2021, they purchased it about 100 million. So now they're selling it at 82 million. So it is a bit of a loss there. But yeah, but it's the thing to highlight is that it's only 2% discount valuations. And that is compared to their prior Manulife. Manulife, they've been trying to sell some of their assets as part of the deleveraging strategy, but there's no good news there. The bids that they're getting, I think I estimate around 30% below valuation, so it's too low for them to let it go at those prices. Yeah, so it's a plus for them for Prime. And for the leasing side, the volumes increased in the first half, but it's still slow, and the occupancy also fell by minus 1.7 percentage points. So the leases that were signed were at negative 1.3% reversions, but the rental rates are around market. So that is still okay. And for the outlook for Prime US REIT, right now, since the major refinancing is already done and they're gearing post the divestment of One Town Center and they use the funds to pay off some of the loans, we expect gearing to be around 45-46%. So that is still within MAS the leverage limits. So now the Prime will be fully focused on driving up occupancy and leasing activity. And they also have not committed to any future distributions going forward. So, but in our estimates, we forecast a 10% payout ratio. So that continues on from last FY23. FY23 they had a 10% payout ratio also. So this first half also same. And right now for Prime US REIT, the physical occupancy is improved to slightly over 60%. It used to be 60% in the previous quarter. So the return to office will really help to bring back the demand for office space. So we expect a full, or rather the things to get better next year or the year after for the US office space, especially when interest rates come down. So with that, we upgrade to a buy for Prime US REIT. So of course, previously we used the 0.2 times price to NAV, which was a target price of 12 cents and that was a target price if Prime couldn't refinance a loan, and we had a 0.3 times price to NAV, which translates to about 18 cents. So that is if Prime managed to refinance a loan. So now that is over, we changed back our valuation methodology back to a DDM, dividend discount model. So that results in a 22 cents target price. So right now, Prime is trading at a 0.32 times price to NAV. And like I mentioned, we continue to assume that they'll pay out 10% of their dividends, and that results in about a 2% dividend yield, which is still better than their peers, but it's not that high, but it's still better than the US peers. Yeah, next slide, please. Yeah, so now I'll go through CLI's first half results. So the story here is that they are shifting towards fee-related earnings. So in the first half, their operating PATMI fee-related earnings, or the FRB business contributed about 63% of FRB compared to the previous FY23 where it contributed less than 50%. Yeah, so for their results, CLI's results are slightly under our estimates. The REIB continues to be weak, but there were a lot of movements in REIB because they divested quite a few assets over the first half, and there's also lower corporate leasing demand and income from the USA. And for the fee-related business, the REIT management was a little weaker, driven by lower event-driven fees, and the PE fund management, they had more funds under management deployed this time around, so recurring fees improved, and event-driven fees also grew. Commercial management and lodging management also continues to improve. And for the operating PATMI, it's slightly down, but that's mainly because the stronger FRB was offset by the weaker REIB business, which was impacted by higher interest expenses as well. And portfolio gains, it jumped up 400%, but that's mainly due to a lot of portfolio recycling activities, like from the divestments. I'll talk about that in one bullet points. So their FRB continues to improve. Right now, they have 91 billion in deployed funds under management, and they have 9 billion of dry powder that they've yet to be deployed. And they are still targeting, they remain firm on their 200 billion FUM target by 2028. And they're also targeting a double-digit FRB growth annually. So this 8% growth in this quarter didn't really hit their internal targets, but we expect it to grow as they deploy more funds and as FUM grows. So they're also on track to hit their 3 billion annual divestment target. So this year, in the first half, they managed to divest 1.7 billion assets. And the good thing is that they managed to divest 710 million of it back into their fund. So they'll start receiving some recurring income from these divested assets. So one example was that earlier this month, they managed to recapitalize one of their assets, Ascendas iHub Suzhou. They divested it as a seed asset to a new China business park fund. And for the negatives for them, the net debt to equity rose from 0.53 times to 0.59 times, and the cost of debt it so rose, but we expect it to remain around 4.1% going forward. So for the outlook, the main thing for CLI is growing their FRB and FUM, funds under management, and fee-related business revenue. So for them, they are pursuing aggressive growth in Asia. So that include countries like Australia, Japan, India, and Korea. And asset classes that they're looking at are lodging, logistics, data centers, and self-storage. And they also do not want to have too much exposure in one specific country. So they are targeting to have no market exceeding 20% exposure, except for Singapore. So for the operating performance under the REIB segment for China, it still remains very challenging as the negative reversions across the board, and there's also lower occupancy even for the so-called stronger new economy sector. And right now for them, they're still looking at divestments in China and USA. So those are key focuses for FY24. And they will continue to buy back shares because they deem it internally as very undervalued. And they're targeting an ROE of 10%. So right now it's about 5.3%. So if they continue to buy back shares, and over time it will bring them closer towards their 10% ROE target. And with that, we maintain a buy call. Yep, no change in our target price, and CLI is trading at an attractive 4.7 dividend yield. So that is attractive considering it's not a restructure, it's more of a property company, and paying 4.7 dividend yield is rather attractive. Yep, next slide, please. Yep. So next we have City Developments, their first half results. So their results were below our expectations, mainly because of construction delays, which pushed back the timing of profit recognitions under the property development sector. So their revenue was down quite a bit, 42%, but that's mainly because in first half 23, the revenue was boosted by the full revenue recognition of the EC project, the executive condo project, Piedmont Grand, because that's how ECs are recognized. It is in full. So for the profit before tax property development sector, there were delays in construction, so that led to lower profit contribution in the first half, and also higher financing costs for those projects that have yet to be launched, but they've already took up the loans to start construction and the land and such. Yeah, so the hotel operations, it improved. So that is stronger RevPAR and coupled with contributions from newly acquired properties as well, especially the one in Australia that helped to boost RevPAR by about 30% in Australia. And for investment property segment, they had quite some significant divestment gains, 120 million compared to 16 million in the first half of 2023. And also some better operational performance for some of the acquired properties, like St. Catherine's Docks. So mainly for the positives for the first half, they had some resilient sales. So the sales relatively stable year on year. So 588 units at 1.2 billion. So there's a slight improvement from 1.1 billion in the second half, rather year on year in the first half of 2023. And going forward, they have two upcoming launches this year. So one is Union Square Residences and another at Norwood Grand. They also acquired some, together with a joint venture partner, they acquired a GLS government land sale site at Zion Road for 1.1 billion earlier in April. And they have also submitted two joint bids for the Jurong Lake District Master Developer site with 4 other partners. So that is the pipeline for the development site for CDL. And the hospitality sector continues to improve. So RevPAR grew 3% year on year. And like I mentioned, the strong growth in Australia was mainly due to the newly acquired properties at Sofitel, Brisbane Central. And for negatives for them, because they had some recent acquisitions and which total about 1.1 billion acquisitions in the first half of this year, as well as the fact that they've been buying back shares, both preference shares and ordinary shares. Their net gearing on fair value of investment properties, it rose to 69% from 61%. So their cost of debt right now is at 4.5%. They have some refinancing to do this year. So we expect cost of debt to increase, but remain below 5%. Yeah, we estimate about 4.8%. And despite all these so-called fundamental challenges in their capital management, like higher cost of debt, higher gearing, they still have no liquidity issues because they have a strong liquidity position with about $1.7 billion in cash. And at the start of the year, they mentioned that they have a 1 billion divestment target for 2024. So they are trailing slightly behind on that. Right now, it's only 271 million. So most of the divested assets are strata units in Singapore. Yeah, so for the outlook for CDL, they continue to want to pivot towards a fund management platform, and they also want to expand the living sector. So these are two of the segments that will help to drive the recurring income streams. So that is compared to the property development sector, as it's very lumpy. And from what we've seen from Piedmont Grand, also they one time recognize in one period. So it's really lumpy, the profits and revenue. And the ABSD at 60% for foreigners, it continues to hurt demand. So there's still no news on the launch of Newport Residences. So we think that will be delayed even further. But there's no ABSD for Newport Residences. The hospitality segment, it should continue to improve. There are still many major concerts going around, mega concerts going around globally, like Taylor Swift is still doing her tours, Coldplay and such. And there are so many MICE events globally, so that should help with the RevPAR growth. So we're expecting low single digit RevPAR growth going forward because of the higher base. And CDL is focusing on divestments basically, and any successful divestments will result in significant divestment gains as their assets are carried at cost in the books. as you've seen, they divested 271 million. Then they had some significant 120 million divestment gains in the first half. Yeah, so no change in our target price. We maintain a buy call, and the target price of $6.87 is a 45% discount to our RNAV. Right now, the share price at $5 is about 60% discount to our RNAV. Yep. So that's all for me for City Dev. I will pass on time to Meow Meow. Thanks.
Thank you, Darren. I'll go through two Phillip on the ground. Firstly is Yangzijiang Shipbuilding. It's non-rated. We don't cover Yangzijiang. And they had a pretty robust first half 24, driven by higher contract pricing and stabilized raw material costs. And they managed to secure the contract win of $8.48 billion US, which is at 188% of their full year target. And revenue increased by 15% year on year, and PATMI surged by 77%. The company's gross margin also improved by 8.1 percentage point. So although Yangzijiang has the capacity to take on new orders and targeting the delivery of the first ship by the middle of 2027 for the order taken place in 2024, Yangzijiang still have no plan to revise its 4.5 billion target. This is because the strong market condition have led the customers to be more willing to wait for longer deliveries, but the trend is actually pretty much on euro compared to the previous years. And something we would like to highlight is there are two LNG carriers defaulted due to the ship owner failed to secure the charter party, and there are the only two ships without deposit. After negotiation, the ship owner actually still won the carrier and is able to pay the original price. However, Yangzijiang is confident to deliver them by the end of 2025 and has another plan to sell them in the open market with a better price. Currently, the demand for LNG carriers is not as strong as the container ships, so this resulting in a lower asking price. However, Yangzijiang anticipated demand to pick up from 2026 onwards. And for outlook, Yangzijiang has been expanding its site to increase capacity, and they have added 17% more to the existing site area, which is expected to take 1 to 2 years to complete. And the new yard has not taken any new orders and is still determining which is the most suitable type of the ships to produce. Very much likely they will be focusing on medium-sized gas carrier. And the exact contribution of the new yard to the overall performance is uncertain now, but it will be more efficient compared to the current one. And demand remains strong for second half 24. Some clients are even negotiating 2029 slots for delivery. And the demand is able to sustain for the next 5 years before reaching the next stage of the cycle. And Yangzijiang is confident to maintain the profit margin in the second half 24. And next slide, please. Move on to Yangzijiang Financial. In first half 24, the revenue decreased by 28% year on year due to the deteriorating macroeconomic conditions in China. So there was a lot of non-performing loans. Non-performing loans increased to 43.5%. And thus the income from the debt investment decreased by 49% year on year. Although like all the investment has been collateralized, liquidating this asset in a timely manner is still challenging in China. And the company aims to decrease the non-performing loan ratio to 40% by the end of this year, and will gradually to solve the loans over the 2 to 3 years. And the annualized return for the investment is between 8% to 15%. And currently, the debt exposure in China is around 30% of the total portfolio, and Yangzijiang plans to reduce it further. The key focus of Yangzijiang Financial is on maritime fund, and they plan to leverage the parent company's industry expertise to invest in the sector. And the Singapore team is actively working on securing new orders for the international companies and place the orders in China, taking advantage of the low labor cost. And Yangzijiang has been providing financing for the ship owners, especially when traditional bank financing is unavailable. So in return, Yangzijiang will introduce the manufacturer party to the ship owners. And upon completion, they'll list the ship to the ship owner and also collect the stable cash flow from the leasing. And it roughly yields a 4 to 5% annual return. The strategy will not only secure financial return, but also will strengthen Yangzijiang's position in the maritime industry. And the company expect to increase the fund size to 2/3 of the total fund in 1 to 2 years. And Yangzijiang Financial currently offers dividend yield of 6.3% with a payout ratio of 40%. And the company is currently trading at 0.3 times price to NAV. And they still remain committed to share buyback when the share price is low. Yeah, that's all for me. I'll hand over to Ding for technical pause. Thank you.
Thanks, Mel. I'll move on to technicals. So first out, looking at the S&P 500, currently we are nearing a retest of the 5,566 swing high resistance form at the start of this month. So I think for this week, we could see a slight pullback ahead, given the run we had last week. For now, immediate resistance is at 5,556 to 5,590 area, while support is likely between 5,445 to 5,505 area. Next slide, please. So next up, we have a technical buy for Adobe at $554.16. Take profit levels at $570 and $610. Stop loss at $533. Last close was $553.46 on Friday. So looking at the chart, price broke out of a downwards resistance line recently, and that came after price did recovery above the $535 support breakdown level. So that indicates that there's a reversal in terms of the bearish to bullish price action. And this was accompanied with a fresh bullish crossover in MACD as well. So if that price could see further recovery towards the two take profit levels, which were prior resistances back in July this year, as well as February this year. Next slide. Yeah, so just to summarize the trade initiated earlier, currently is down slightly, about 0.1%. Yeah, so that's all from me now. I'll hand over time to Paul to talk about HRNetGroup results. Thanks.
Yeah, thanks. Thanks, Dean. So I have a few results to brief. So I'm just checking my video. Okay, so sorry for that. So for HRNet, the results were below expectations. I think for HRNet, for those who do not know, so they are involved in two main business, which is professional recruitment, which is essentially like your headhunting business, and flexible staffing, which is basically temp jobs. So like recruit first, if you're looking for a temporary job, they are the ones who recruit. And the model is that they will pay the salary of this temp staff on behalf of the company. So the cash flows is an important barrier to entry. So the positive was that flexible staffing was stable. This is in part because these days corporates are cautious and they are rather focused on temp staff rather than permanent hires. So as a result, the negative was the professional recruitment. It is still sliding. There are two main markets, is Singapore and North Asia. Both markets also continue to contract. As a result, you can see that their earnings was down about 16% year on year if you look at the table on the left. So we cut our earnings by about 6%. So basically what is happening is that there's caution not just by the client but also by the staff. So clients are more careful in the hiring. And the second part is that even the candidates are also more careful. So they have actually candidates that actually reject their offers, mainly because the environment is cautious. So a lot of candidates are not willing to change jobs, or basically the churn rate is lower. So like we mentioned on the third bullet point, macro backdrop is big with cautious corporates and candidates. It's still an attractive business. I think their ROE is still like more than 50%. They have a strong net cash, and also the dividend yield is about 6%. But the macro conditions is just putting slowing the growth for this company. Next slide. Moving to PropNex, so we expect a stronger second half. So for PropNex, the results were below expectations. They were like 33% of our full year results instead of about 50. The positive was that there was a growth in the resale. So we look on the table on the left, the private and HDB resale actually doing well in view of the environment, even though there was additional buyer stamp duty imposed April of last year. But what really took down the numbers was the 20% drop in project marketing. So project marketing is essentially new launch sales. So that has the second year of contraction. I think in line with what we saw, I think first half of this year, new launch units were actually down about 40%. One of the reasons is because new launch is big because there's a lack of units being launched. It's not due to the developers, but I think from what we understand is the authorities that's delaying. We lower our earnings by 11. We upgraded it to a buy, mainly because of the share price weakness. So for the second half, we think there'll be a recovery, mainly because there are about, I think, more than double, 2.5 times more units to be launched in the second half. So first half, the new launch was 2004, including 500 units of EC, which is the CDL Lumina project. So you can see that there's going to be a lot of launches. So there'll be a lot of people passing you brochures, I think, by the second half. But we still like PropNex, mainly because they have a very dominant share. So they have like 2/3 market share of all the agents. I think the agency force now is about 13,000 agents working for them. And almost 2/3 of every home transaction, which is private or HDB resale, actually is done by, including home sale, new home sales, is actually done by a PropNex agent. The only area where their market share is not like 60 is probably in rental, because rental, some of the smaller real estate agencies can actually play in that segment. Next slide. So to give you a sense, so this table basically shows what they were forecasting. So in February, PropNex was expecting new home sales to grow 9 to 17%. But of course, now their forecast now is to drop because there's been a major, because of the delay in launches. And all this is explanatory. Then the table you see here just for price. So they still think prices will go probably 4 to 5% for private, but I think they think the HDB prices, they are the most aggressive. I think they think can jump about 7 to 8%. So just to give you some flavor of what's happening, most of it is in the report, but for new launch, the one thing about new launch is that the window is very narrow. Because in second half, you can only launch maybe September to mid-November, because after that you have a Ghost Festival, cannot launch, then holidays also cannot launch. So you have these 2 months, September, October, and mid-November to launch. So it's going to be very narrow. A lot of units are going to be launched during that period. Private resale is still healthy because of the difference in pricing. So between new and resale price, the medium price, probably like a 40% discount. HDB remains very vibrant, HDB resale, because of the attractive grants, and even the new BTOs that's coming up, the price between the new BTO and resale is also narrowing. So more and more new BTOs are getting more expensive. And there's this unique thing where, if you recall, in September 2022, the authorities introduced this rule whereby a private downgrader, I wouldn't say downgrade, but maybe switching to HDB, need to wait for 15 months before they can buy a HDB after they sell their private. So that rule, if you count 15 months, ended early last year. So that's why all these private owners that sold starting to emerge now and probably pushing up the HDB price. But HDB price has risen very strongly. If you look at the last 4 years, HDB resale price is up almost 40%. So around 10% per year. And HDB resale is important because HDB resale will push for upgraders market, because they will, when they make enough, when they generate the equity or the gain, then they tend to upgrade. So that will support the private new launch. But again, private new launch is also hitting a bit of a ceiling, because I think what they mentioned is the OCR, or like a better word, the mass market. I want to call it mass market. I mean, the sweet spot now is 1.7 million. I'm not sure why is it called a mass market, but that's 1.7 million is a sweet spot. Anything above 2 is getting harder to sell. There's a bit of a ceiling. Next slide. So for Singtel, actually most of the prices, actually mobile prices were up, cost was down, but the problem is currency. So the results was in line. So the positive was the Optus. So if you dial back again, so for Singtel, they have Singapore, of course. Then they got Australia that they own and operate. The problem with Australia was that the returns was very low. The ROE for Australia was probably 1 or 2%. I'm not sure what kind of returns those are, but they're very low. So they've taken a very aggressive move to cut costs. I think headcount has been also been lowered or right size or whatever politically right word to say. But so that is also helping. You can see that even though revenue is down 4%, the EBITDA is actually up for. So this is part of their 200 million of cost cut they want to do per year. The negative is currency. So if you can notice here, the associates was down 5%. There was a 4, a bit, I think it'd be hard to see, but I say 4.4% impact by currency. And to give you a flavor, so Telkomsel is their Indonesian mobile arm. So that earnings was probably flat, but there was a 6 percentage points. So the rupiah dropped around 7%. So that kind of hurt their earnings. So currency is a big issue. And even for Bati, you see this 29% drop because in Bati, they have translation loss of African currency. So Bati standalone, the business was hit by currency. So currency is hitting them, I guess, left and right. We nudge our earnings a little bit just for depreciation, but we still have accumulate because we think that the operationally things is still strong because they're getting this 200 million cost out in Optus and also Singapore. And then associates, that means they own associate stakes. They don't operate, but they own associate stakes in like Thailand, Australia they own, and also India. They're all enjoying higher mobile prices. Like India is pricing higher in July. So why are mobile prices rising after so many years? Is because it's consolidation. So Thailand consolidated from 3 to 2, India from, I don't know, 10 to 2.5, because the other half guy is probably like very weak balance sheet. So it's like not operating on so you call it like a half competitor. But the headwind now is currency depreciation. Anyway, move on to the next. So for Comfort, so finally in UK is a source of growth. So the last 2 years, UK was essentially loss-making or hardly profitable. Next slide. So the earnings, if you look on the bottom, so for Comfort, their earnings was up about 18% year-on-year for second quarter, and they actually increased their dividends by 20%. So the results was in line. So the two main areas that they're doing well is actually Singapore taxi. So you'll notice on the table on the left, I know taxi, everybody complained, but the earnings actually grew 48% year-on-year. So why is that so? Is because of this platform that they rolled out, Zig platform. So with Zig, what happened is so when you book a ride on Zig, they introduce a platform fee. I think it's 70 cents. Then they also raise the commission on the app. That means if the usual, the commission on the drivers. So all this goes straight down to bottom line and strong margin. So that's why you can see the earnings jump of 40%. The other one that did well is the UK. If you look on the table on the left, so UK made 8.6 million and it swung from a loss of 2.3. So we'll explain why later. But the negative is Australia. So Australia, the earnings was actually down if you exclude some of these one-offs. So we maintain our earnings target price. We still think second half will be another 2 quarters of growth, and mainly because it was driven by the UK business. So UK margins right now is probably 2-3%, but they are recontracting new contracts at maybe mid-teens to even 20% margins because of the huge competition. A lot of competitors have exited. They used to have 5 bidders per contract. So these are bus routes. That's basically contract to just drive the bus around and around and around, especially in London. But used to be a lot of competition. The margins was low single digit. Now it's jumped up to mid-teens. And the other thing is CMAC. So CMAC was a new acquisition. They paid 100+ million, I think 160 million if I'm not mistaken. So that usually second half is better. So this business probably very new for investors, and of course for me, is that it's a very unique business where the airlines engage them, where if there's any travel disruption, like what happened to the CrowdStrike, then they will just call them and CMAC will arrange hotel bookings, transport, everything. It seems like a very nothing great, but the difficulty is that their systems are linked to the hotels. And of course, hotels won't let everyone link. So they can actually see the inventory for hotels and try to make the necessary arrangements. So when travel season is high, their earnings will be stronger. So second half will drive, and of course, Singapore and China taxis. The weak spot is Australia and Singapore Rail. So Singapore Rail is hardly profitable, if not loss-making for them. So just one final point for UK, only 15% of their bus routes are now on the higher margin. So they probably got another 2 to 3 years to reprice everything to the higher margins. So this will give visibility to the UK earnings. Next slide. ST Engineering was a broad-based growth. So next slide. So what we say that, ST Engineering gives financials on 8 divisions. So 7 of them did enjoy growth, except one, which is the Satcom explain. Yeah, sorry, the print is a bit small because we have to try to include so many things and they got so many divisions. The results of within expectations. The one that gave the growth, you can notice, is the aircraft MRO 1 billion business. So that grew 30%. So aircraft MRO doing well because as more planes are being used, they will need to have the usual airframe maintenance. They need to maintain the engine. Otherwise, we'll all be in trouble if you travel. And the problem is because of the delay in aircraft. So Airbus delay their aircraft. So some of these fleet have to be flown longer. So that's why. The negative is the Satcom. So Satcom, I didn't highlight here, but you notice a bit harder to see here, but the Satcom above the EBIT line, it's down 20%, the revenue. So Satcom is basically the equipment that they use. Okay, so let me just recap, sorry. So ST Engineering have 3 main business: the commercial aerospace, they maintain aircraft, they convert aircraft, they even sell engine parts manufacture. Then the defense is, of course, supporting the Singapore defense budget, and also selling ammunition and selling can be Broncos, land vehicles, maintaining of frigates for Singapore and so on. And then they have this urban solution, which is the TransCore that they acquired a few years ago. So TransCore is like our so-called ERP. They do ERP systems. And of course, Satcom. So Satcom weakness, let me get back to that. Sorry to jump around. So Satcom weakness is because they do ground equipment. So when you are, let's say, somewhere in the Sahara Desert, that's pulling some very desolated place. They provide equipment so that you can connect to the satellite. So they used to do GEO and MEO satellites, a bit those higher orbit, but now all these LEO satellites have come and competition is coming. So they are in a bit of a transition because they need to launch a new product. Okay, but anyway, I'm not going to go through all that. It's a bit. So anyway, we raise our earnings. We still think there's growth for this company because of rising air travel. The defense spending, one thing good is that they are selling more international products. Lack of better words, actually ammunitions like howitzer, 40mm, and the one 40mm kind of ammunition, and that has higher margins because these are products. So we maintain our buy. We think second half should be stronger because the USS is also typically stronger for the second half. Yeah. Okay, next slide. Yeah. Move on to Starhub second quarter. Yeah, so for Starhub, we downgraded our results because the earnings was a bit lackluster. I think so if you look at the results, second quarter results was within guidance, but the problem worry for us is was that you will look on the left here, the mobile is starting to decline. So mobile is the largest business, and then they are down about 4%. I'll explain later, but the positive is healthy cash flows. Usually we say that is a positive because when the operations nothing positive, so we just talk about cash flow. So the negative is that the mobile service revenue is down. You can see here 4%, and it has been declining for the last 2 quarters. And we worry that the competition is going to pull this down. So our forecast is unchanged. But we worry that competition because of the lower price MVNOs. So MVNOs are operators like Circle Life. They actually don't have the network, but they will just lease the network from Starhub, can be from Singtel. Because like I said, they don't own hardware, they just sell you the service. So a lot of aggressive competition. And now competition is also spreading to broadband. Because Simba, there used to be the TPG, they're now called Simba. So they just launched broadband early this year, and that's also going to put competition. So We think this stock operationally nothing going to happen. The only thing is that they are paying at least 6 cents of dividends at the very bottom, because that's within their guidance. So there's still some yield, but I think it's like 5% yield. But in the meantime, operationally nothing exciting until next year, where they have some cost savings that they're going to do next year. Yeah, next slide. Okay, I'll go. Yeah, okay. Anyway, that's all the results. Probably too much, but let me move on to the weekly. Actually, most of the news was generally positive for macro news, except residential. So the arrivals in Singapore still strong. In July, it's up 12, and China is still a lot of China arrivals into Singapore, about 78%. The property is still very weak. July is down a huge 60%. So first half 40, then July already 760. So still not very, no encouraging signs yet for private new launch sales. Singapore exports actually holding up, likewise for Korea. So for this one, US retail sales, the market did rally in the US, mainly because of the stronger retail sales. Even if you take out gasoline, because gasoline price is also still healthy. I wouldn't say it's robust, but it's healthy, like similar to pre-pandemic levels. Next slide. We'll do this quite so the market sentiment is actually oscillating. So one day the market will say the US is in recession, then the next day, every data point, now that retail sales is a bit better, they say soft landing. So the market is just swinging left and right between recession to soft landing. But regardless, we think September a rate cuts is on the cards. I mean, it's going to happen, just whether 25 or 50. I think the market now pricing about slightly 1.5. I'm not sure how to calculate that. So that's to give you a flavor of all the results. So for results, from what we see, domestic spending in Singapore is still weak. Like mentioning HRNet, supermarket Singtel also quite weak, domestic. Conglomerates is more a 2025 story. So for conglomerates, you know, like your Sembcorp Industries, Capital, they did very well last year, because last year they had this blockbuster earnings from selling spot market electricity and also selling their LNG. So you're not going to have it this year. So this year more consolidation, and next year is where renewables especially can grow back, can resume growth through renewables for Sembcorp Industries. Telcos we mentioned enjoying higher mobile. Land transport, there's an ST engineering steady state. Yeah, and then China is the weak spot for most of the companies that we speak to. It can be Mapletree Logistics, it can be a CLI, I think. Yeah, and also margin improvement. So we saw like F&N margins are improving, and even Wilma also mentioned their margins improving because their raw material cost is coming down. So just to give you some themes, for the events will be the Fed meeting, July minutes. So the market is going to go through it with a fine comb, with a big microscope to see whether, especially whether in the July meeting, were there any Fed officials that said that they should actually cut in July. So this will give more confidence to the market that there will be a rate cut in September. Of course, then Powell will be speaking on the Jackson Hole meeting, where all the all the central banks will be there. We have some events. The new one that we added was Micromechanics, because not a big company, but they hardly do webinars. So that's the new one that we added. And also VinFast, if you want to know how about EV cars. Next slide. Okay, this one just to show the strength. This is just for reference. So you can see that residential new home sales over the last 12 months is, I think, going to continue to scale lower. Probably more than 10-year lows. The last low was during the global financial crisis. So the sales of home sales now is similar to global financial crisis. I'm not sure that's a good number anyway. Yeah, next slide. This is just to show you that electronics is still holding up. Exports, electronic exports are still holding up. Next slide. This is just to show the retail sales, which actually help prop the US market. I won't say it's very robust, but actually it's holding around 3%, similar to pre-pandemic levels. Yeah, next slide. I'll end it with Wilma, since we always get a lot of questions, Wilma. So there was an earnings briefing. So just to recap for those who may not know Wilma. So Wilma has a palm oil plantation. They also refine oil. They also do soybean crush. So soybean crush means, you know, they buy soybean, crush it, then the mill, they will feed the hogs or pigs in China. They also sell edible consumer packs in China, branded the Arana brand through the YKA or YKO. So the financials was actually up about 5% year on year. I won't run through everything, but let me just give you to the comment. So they are actually, second half seems to be better. I think second half will see an improvement in earnings. Firstly, because palm oil production will recover. Because in the first half, palm oil production was down 6%. So that will affect their, of course, palm oil revenue and plantation revenue, and also some of their refining margins. And then number two, they think that soy crush margins, that means, you take the bean and crush it, the margins will improve because hog prices or pork prices is starting to rise. And because soybean is also pricing is lower, the farmers are willing to use more soybean, the so-called inclusion into the feed. So that will also support the sales of the soybean meal. And then China demand, they think consumer demand seasonally is stronger. And sugar, of course, the worry is sugar, because sugar has done well for them last year, second half, but they say that they hedge out well, and probably the impact on sugar will be less. So second half looks healthier for them, for Wilma. Okay, I think with that, I think we can move on to Q&A. Thanks.
Okay, I'll just take some Q&A first then. I answered the one asking about the impending rate cuts in September just now during, but maybe let me just reiterate again very quickly. For the banks, they will probably see their net interest margins take a hit slightly. But net interest income will still be expected to remain stable because they have managed to move their excess deposits to manage the net interest margin and net interest income. So we will see it flattish. We won't see much growth in the NII or net interest margins. But with the rate cuts, it's also a good thing for their loans growth. So loans, that goes into the second question. Someone asked, will loans growth offset NIM decline? I think that was the question. Yeah, will loan growth be able to offset the drop in NIM? I don't think it's really, it's not like an apple for apple comparison, right? It also depends on the market, how well the loans grow and whether it would, how much rate cuts there are also, right? So if there's only maybe a handful of rate cuts, then the interest rates will just drop a little bit. Loans might pick back up, yes, but it might not be enough. Or it really depends on how the consumer feels, whether or not they can really take up the loans. I think it will be able to offset some of the decline in the net interest margins, but whether we can see it help the net interest income grow and high single digit, I don't think that will be possible. Yeah. So what will be the factor for the banks, and these will be the fee income, especially the wealth management income for the three banks. And that would be the thing that I think all the banks are pushing, especially UOB. I mean, UOB is the one that came out with their corporate day to say that yes, they are going to focus strongly on that. I think the follow-up for the question is that someone asked about the REITs as well, how the interest rates will affect the REITs. I'll leave that for Darren. Someone asked about I think just the US banks, right? Wells Fargo, Goldman, JP Morgan, Citibank. We do only cover, out of that few that you mentioned, we do cover JP Morgan and Wells Fargo. So I'll just speak more on that firstly. For JP Morgan, they will be able to continue, excuse me, growing their revenue in all segments, particularly in their consumer and community banking, as well as their corporate and investment banking. But they do face some headwinds to their net interest income from deposit balances, as well as potentially higher provisions. So the US banks in general are facing much more headwinds, from their cost of funding. Unlike the Singapore banks, because there's only 3 Singapore banks, right? So they don't really have much cost of fund pressures. But in the US, it's quite different, where the cost of funds really eat into their margins and their net interest income. But for JPM, I think they will be able to continue growing strongly in their management fees, as well as the continued net inflows to support their earnings. It's quite similar for Wells Fargo as well, but Wells Fargo, I think their funding costs are hurt a lot, I guess, more severe than JP Morgan, because their JP Morgan is the largest bank, right? So if they say they want to lower slightly the funding cost, the competitors will just have to follow suit and so on. So for Wells Fargo, they are hurt more by the funding costs and also their lower deposit balances. But they do see some continued growth in their non-interest income, particularly the recovery in the investment banking fees and also the higher gains from trading activities. But for Wells Fargo, I think the big difference is that they have said that they're gonna sustain their increase in share buybacks. So this will benefit the EPS. Let me talk about the other few. I think it's Citibank. So Citibank is more of a cost, whether or not the management and the new CEO is able to restructure the whole bank. And if she can do that properly and well, then I guess that will be good for the bank. But otherwise, they face the same pressures with the costs as well as the upside will be, of course, their fee managed income and their investment banking. Let me try to find the question. Give me a minute. Oh, and then they also ask for TA, so I'll leave that for Zain. I think. Oh, yeah, there's one more question on SGX, I think. Yeah, SGX and iFast. So for SGX wise, they did release their recent second half full year FY24 results. For SGX, we do expect stable growth, from the improvement in their currency derivatives volumes, and also, their focus on the OTC FX pillars, which they have and they're also trying to acquire new clients across Europe and Asia Pacific. So that's how they're trying to grow the OTC FX segment. And they are also, I think quite they're guiding for their expenses to remain very contained and to remain stable. So that will probably be helping them to cut down their costs, whereas the rest they can't really control. But one thing that they do face headwinds, and I think will hit their earnings quite a bit, would be the treasury income. So treasury income for them makes up quite a large portion. So it was down, I think 24% if you look at the, sorry, let me see, I think it's 24% for second half 2024. It went from 90 million to 68 million. So that's a good like 22 million down. And we haven't even seen the rate cuts kick in yet. So if we do see the rate cuts kick in, I think this could drop even further, the 68 million that they have, and it could hurt their earnings quite a bit. The target price for SGX will be $10.78. We do have an accumulate on SGX. For iFast, we don't cover, but very briefly, iFast, what we're looking at is that they have seen good growth. I mean, this is coming from their Hong Kong e-pension business, which provided quite a big burst, a surge to their earnings. But also their baseline business is growing. What was mentioned is why we suddenly see this huge uptick in their AUM, right? Assets under management. Oh, it's because the markets are doing better, hence that's why the AUM also grow in tandem with the markets. So I guess that's one of the reasons that they said. I think since the AUM has grown, their fee income from this AUM also grow together with the AUM, which is why we saw that. I think the driver for iFast would be their global bank. They have this UK global bank. They are trying to really push that agenda out there and pushing deposits, but it's still loss-making. Hopefully it will not be loss-making. It will break even by the fourth quarter, and then next year we can see some profits. They make some profits for iFast for 2025. Yeah. I think that is all for me. Yeah. Someone asked for the TP for all three banks. I'll put that in. I'll answer that there. Okay, I'll hand it over to the rest of my colleagues. Thank you.
Yeah, thanks, Glenn. A couple questions here. Hi, Jonathan. The gold price has a good run and continue to be so. However, this has not been the case for Barrick Gold. Your comments, please. Yeah, actually, for Barrick Gold, I think they had some production issues the first half of this year. They had a slower than expected ramp of its new plant, and then they also had a maintenance, so that they shut down another plant. Yeah, so then obviously that puts pressure on margins a little bit. So that's one of the reasons why Barrick Gold has been underperforming gold. Because typically it kind of goes hand in hand because just your assets appreciate, valuation increases. Yeah, hope that helps. Another question here on hi Jonathan, SWN was supposed to merge with CHK. I think CHK is Chesapeake. Yeah, so basically they're two energy companies. I think they're currently undergoing SEC questioning, so that's why it's delayed a little bit into the second half of this year. Yeah, other than that, not really any. Yeah, I think that's all for me. I'll hand it back to the rest of my colleagues. Thank you.
Yeah, I'll follow up on that question that Glenn answered partially. So if the rate cuts, what's the outlook? Any positive impact on the REIT sector? Yeah, so for REITs, the rate cuts will benefit REITs a lot, like significantly. So one of it is, of course, cheaper finance costs. So that will, when finance costs go down, basically your distributable income will be bigger because you deduct less, like between the NPI line, you deduct less finance costs. So DI and dividends will improve. So that's one. Then with lower interest rates also, transactions volume will likely to recover as it will be cheaper to borrow, and as a result, cheaper to borrow and cheaper to invest. And so that's two. And also with the cheaper, or rather, if lower interest rates, cap rates will likely to start compressing as well. So that will result in higher valuations. So those are some of the bigger reasons why, as well as the dividend yield spread also. So when interest rates come down, the 10-year yield will also likely come down. So the dividend you get from investing in the riskier REIT asset class as compared to the risk-free rate or the 10-year yield, the 10-year bond will start to improve also. So that's why the lower interest rates or any cuts in interest rates will benefit REITs significantly. Prime PS REITs updates, yeah, I just gave an update of the results in the slides. So there's a question on why buy capital and invest when there are REITs, CICT, Ascenders, Escort giving better returns. Yeah, so for REITs, the play here is more of still dividend yield, but for CLI we see there's a lot of capital appreciation potential. So that's mainly because of the FRB business. Like normally for the fee income business, we give a PE of double digit. So in my case, I give a PE of 16 times. So as they start improving their fee income and the operating PATMI, the contribution, more of operating PATMI's contribution come from FRB. So that PE ratio will start to improve. Will start to increase, and that is also why we think CLI is undervalued, because eventually when we start valuing it more on a PE basis, it will, yeah, it's quite cheap. Yeah, so that is CLI, more of capital appreciation rather than the dividends. So the dividends that I mentioned in the slides earlier is a positive for them. For CLI, one hand, they are divesting China due to poor sentiment, but we are reinvesting back to business part in China, isn't it? Right? Yeah, so I need to explain this clearly. So first of all, they are divesting China assets. So that is, they are lightening their balance sheet. They are divesting these China assets to reduce the balance sheet exposure to China, but they are moving it more into a fund structure. So this fund structure, they will retain a small portion of it, like maybe 10-20% of the fund or sponsor stake. And then they will find like, I'll use the most recent China, the Suzhou, Ascender Suzhou example. So they divested Ascender Suzhou from their balance sheet and to basically into a fund structure, and they've secured a major onshore institutional investor as the fund's anchor investor. So basically, they once they move it to the fund structure, they will start, or rather they'll continue to receive recurring income from managing the property, and they also basically reduce exposure in their balance sheet. So that is a plus. Yeah, I hope that explains it. Like basically, they want to reduce their balance sheet exposure and move more into this fund structure. They maintain a small stake in it, and at the same time, they continue to collect recurring income streams from managing the portfolio and collecting fees, like from fund management fees and asset management fees. So yeah, that's their business model going forward, and they plan to expand this FRB segment, the funds under the free related business segment. Yeah, so I hope that explains it. what's your target price or impact? Yeah, we do not have a target price because we do not cover impact, but maybe I'll leave that question to Zane. You can do some TA. And how does a weak China economy hit CLI? Yeah, because CLI they still have they have 35% of their AUM under the REIT segment that is still inside China. So with the weak economy hitting, with the weak China performance, basically they still get lesser income from the operational set of things like the weaker rental reversions and lower occupancy. So basically they collect lower revenue from the balance sheet assets. So that is basically how the weak China economy continues to hurt CLI. It's more of the REIT segment, the real estate investment business side of things. Yeah, I think yeah, there's one more. Is Keppel DC REIT at 1.4 price to book expensive? Is that a TP? Yeah, our target price for Keppel DC REIT is 1.93, so it's slightly is below the current price of $2 plus. Yeah, and for Keppel DC trading at $2 plus, the yield is like 4% or even lower. So we do not think that is very attractive for a REIT play. Yeah, unless you believe Keppel DC the share price can start to improve and grow even beyond the 1.5 times price to book. So in our view, we don't think so, which is why we have a target price of $1.93. And the yield is not very attractive at 4%. Yeah, I'll pass on to my colleagues. Thanks.
I'll take the C question. So there's one asking, C raised their seller commission fee above TikTok and Temu. Will it risk losing market share? I mean, yes, because if they increase the commission fee, then of course the sellers are going to be less motivated to sell on the platform. There's always going to be a trade-off. So the key here is whether it's a wise move. Will they end up losing too much and make it not worth it? Well, if you take a look at any e-commerce platform, if you take a look at the long term, there's always going to be a consistent upward trend of intake rate. This is quite predictable because when you're new in the market, you always try to attract sellers with low, more appealing take rate. Then once you feel that your sellers become more sticky on your platform, you always try to adjust it up and increase your revenue capture. So post-COVID, which is end 2022, that was the period when Shopee thought, because after the entire COVID period, they did a lot of hard work to build a market, to assume leadership in the market. So it was time probably for them to start reaping off the benefit. So that is when they start adjusting their take rate upward. So it reached a peak in the start of 2023, where the take rate is almost reaching 10%. So that is actually a pretty bad time because TikTok Shop just started entering the Southeast Asia market. So around that time when they reach 10%, the GMV growth pretty much become flat or even negative. Then for 3 quarters ongoing, sellers were complaining a lot, saying that they're not willing to pay much because they can just sell on other platforms. So that's when they realized that they're going to lose a lot of market share. So they start dropping the take rate back for the next quarter. So that was the third quarter in 2020 in F123. So that's when they see a quick rebound in their GMV growth. So fast forward to now, it seems like for the past few quarters, the general trend, for the past quarter, we do see a general trend of take rate increase across the entire industry. So C is saying they're seeing it as a sign of less competition, or at least more stable competition. That means the market is stabilizing and all the players, instead of fighting for bigger market share, aggressively expanding, they're actually thinking more of revenue capture. So Shopee, they did a lot of hard work increasing their logistic capacities. They're also spending a lot on sales and marketing. Their GMV growth for the past few quarters have been very strong. So I guess they're at a place where they're pretty comfortable enough to start reaping the profit again. So we're gonna keep monitoring how their GMV is to see whether it's gonna affect them in a long period. Yeah, I guess that's my question. I'll pass my time to my other colleagues.
Meow Meow.
Hi, I'll take CL. China Aviation Oil, despite the good result, have not moved up. Sales price has also been coming down. what is your view on WHO advisory on mpox? Will those tourism share be badly affected? Yeah, so for CLI, the result is good. And the good result has already been pressed in our view, yeah, before the result. So it's like a consensus, like the air traffic in China has been picking up this year, and CLI is the top beneficiary. And the first half 24 result is good, and the profit from Shanghai Pudong International Airport accounted for more than 50% of the group profit. And we believe the trend will continue and deliver even stronger second half 24. Because like typically second half is seasonally stronger. And for the numbers of case of for the mpox issue, the number of cases of the mpox have declined in most of the areas in the recent months, and so far it's still like only prominent in Africa. And generally, it's like how it transmit is through like skin to skin or mouth to skin contact. And the vast majority of the cases like through the among the men who have sex with men. So it's currently no restriction to the travel relating to mpox. Yeah, although like WHO advised like the recent close contact of kids to avoid traveling. We don't believe like there will be as serious as COVID, and so it probably will only affect the area in Africa. Yeah, so far. And for Yangzijiang financials, NPL seems to be consistently high of 43%, while dividend are still safe. So the redemption of the debt is getting difficult in China because of the pretty bad macroeconomic condition. And Yangzijiang has been working with the court for the non-performing loans. So basically, if the counterparty fails to pay the interest or the principal, Yangzijiang will sue the counterparty, and so the collateral will be put up to sell. And all the loans are collateralized, and it just like takes longer time to liquidate the asset, especially during the current macroeconomic condition. And Yangzijiang has been extending the installment. So if that's an installment for 2 years, now they're extending to 3 years. And they're not giving any new loans anymore, and aims to reduce the NPL down to 40% by the end of this year. But generally, we believe the dividend will be affected this year, since the income from the debt investment actually decreased by 49% in the first half. And it still accounted for like 30% of the overall portfolio. Yeah, so it takes time for the business environment in China to get better. Yeah, and dividend will be adversely affected this year. And Yangzijiang Shipbuilding, any negative impact on Q4 financials with the default on the 2 LNG carriers? Yeah, so technically it's not a default because the buyers still want the 2 carriers at the original price, but Yangzijiang decided to complete it and sell it at a better price in the open market. And the effect is more on the capex side, since there's no deposit for the 2 carriers. So Yangzijiang will fund the construction of the ships using their own capex. And the effect is like still marginal to Yangzijiang's overall financials, because like they aim to deliver 63 ships this year. Yeah, so far they completed around like 37 of them. So like the 2 LNG carriers is still like a fraction of the total amount, and the capex will be evenly distributed for the next 2 years. Yeah, so the effect for one single year, one single quarter will be like negligible. Yeah, hope it answers your question. I'll hand over to rest of my colleagues. Thank you.
John, you want to take the nano film or an AEM if it's possible? Oh, so the NVIDIA, sorry, the NVIDIA question on the chat. Yeah. Okay, let me just run through some, then we can just go for what's the outlook for Food Empire, Wilmar, Vicom, the Hourglass? Okay, I will do very quickly, but for Wilmar, I think we mentioned. For Vicom, they should be stronger in the next 12-18 months, because there is the new, I think all of us going to have to install, especially those fleet vehicles, those commercial vehicles, have to install the new new device. I forgot, is it the OU or the output input, the device for the new for the new ERP system, sorry, just the onboard, sorry, the new onboard unit for the ERP. So that could actually help Vicom, because you got to do the installation. So the next 12-18 months could do well. For Food Empire, our general view is that I think near-term earnings will be down, will be weak, because when coffee prices increase, it will take time to pass on. Because the existing customers have their own inventory to clear before they buy the new higher price, higher price 3-in-1 coffee that Food Empire buys. Because coffee spiked up, then they need to, when they want to price it higher, it will take time, because they're still selling the lower margin ones, because they haven't passed on the price yet. So it's a bit more of a lag. For Hourglass, okay, I don't look at it closely. We do go for the AGM, but with the second hand, we try to meet them, but they say no. But the second hand prices coming down is going to impact them, because second hand luxury prices are down, I think 10% this year, 40% from the peak in somewhere in 2022. So and with the macro environment, maybe the demand for luxury will be impacted. I mean, just our general views. For Genting, results were positive, yet no upside. Okay, let me answer this, then we go on to the technicals. So for Genting, what we understand is that I think the market is very cautious on visitor arrivals. They are not going to give. Okay, so firstly for Genting, they are not giving very aggressive dividends, although they are super high cash, because they want to spend it. They got a 6 billion capex spending to expand their IR. Then the second thing is that I think the market just worried that with China, because the first half was strong, because as you can recall, China really the first half of last year, China arrivals didn't come in, and then with the visa free and so forth coming in, then that's why China arrivals spiked up. So market is just nervous of second half, the arrivals from China. So, and the big overall economy in China. So I think that's the one that's causing people to hold back, to be worried about Genting results in the second half. But do note that you can just imagine one IRR is looking to spend 6 billion. So two IRRs are going to spend 12 billion. So most of the benefit will come from the construction company, building materials. Because Singapore spend about 30 billion a year, and these two IRRs alone are already like 12 billion. Although they're going to spend it over a few years, but you can see the enormity of the construction spending. But I think the worries over tourist arrivals is the one that's putting the overhang for Genting. Okay, I think I hand it over to Zin for the technicals. Yeah.
Thanks, Paul. Yeah, I'll move on to the technicals. Yeah, so first question is on AEM. Yeah, so for AEM, I think in terms of the longer term trend wise, it's currently below this downtrend channel support over here. After the earnings, it was a gap down and it continued to trend downwards. So I think for now, next support level probably is around $1.12, and next one is around $1.07. Yeah, so for now, still some near-term weakness to be expected. The next one is for Singtel and CLI. Well, for Singtel, I think price should be quite range bound. Recently price there was a recovery back above 290, which was this key support level here, and then still facing some resistance at $3. So I think price should be still quite range bound in this $290 to $3 for the short term. Then for CapitaLand Invest CLI, price recently went to retest a swing low support at around 247, and some support came in. But should be still finding resistance around 260, this previous support area. So I think should be quite range bound as well from this price around 247 to about 258 currently. Okay, then moving on to the local banks, start with DBS. So for DBS, I think some rebound currently, but price real retest of this 36.20 this previous range resistance. So we should be seeing some slight pullback in the near term. I think support should hold at this level around 34.90. Yeah, so price could do some consolidation for the time being. Then moving on to UOB. UOB also some near-term resistance, I think, should be around $30.90, 30.90 about there. With this downtrend resistance line, as well as we'll feel this price gap over here. Yeah, so I think for now, maybe some price could go out a little bit higher before some sideways consolidation. With support around $30, about 30.25, 30.26 over here. Okay, then for OCBC, price recently, there was a recovery to retest this previous support level, the strong support level around $14.45. Then currently seeing some resistance around there. I think price should do a bit of a range bound consolidation as well, with support coming in probably around $14 to $14.10 this area. There's a previous range resistance back in May, then this recent level over here as well. Okay, then next one is on some US counters, start with Wells Fargo. So for Wells Fargo, I think currently price is doing some rebound from around $50 support, but I think we should see some resistance coming around the $56 area, which was this previous. It was actually a strong support previously back in March as well as in July. So price could do some bit more recovery upwards, then we could see some sideways consolidation hit with support around the 53 to 54 area. Okay, then for Goldman Sachs, I think also nearing a retest of this 500 and 910 resistance level. So perhaps a little bit more upside before we see some consolidation afterwards. With support probably coming in around 493 to about 495 area. Okay, for JP Morgan also see quite similar. Price recovery back. Price managed to recover back over 209 this level, and we should see some further upside towards a retest of the highs around 216, 217, and some sideways consolidation after with support probably around 210 to 212. Okay, then for Citigroup, also we should see price move up a little bit higher towards a retest of this previous support breakdown level around $63. And then also some consolidation afterwards with support around $60. And last one is on Jackson Financial. For Jackson Financial, currently price recovered back to retest this swing high around $90. So I think for now we should see some slight pullback from this area with support probably coming in around $85 area. Yeah, we could do some sideways for the time being. Okay, then what's your TP for MPAC? Okay, I'll do a TA for MPAC. I think MPAC generally still quite range bound over here. Yeah, price is still holding around support 123, but resistance will be around 130 as well as 133. So I think probably can expect some sideways movement ahead, similar to what we saw over here back in May to July this year. And then some Thai Bev, Sembcorp, and Seadrill. Okay, for Thai Bev, I think price here retracement towards the support level again at 47 cents. So I think for now we should see some rebound back to continue this range consolidation between 47 cents to 52 cents. So price could do some recovery upwards to continue this range trade. And as for Singtel Industries, I think recently price currently is holding above this 460 level. Over here previously there was a breakdown. So I think that's slightly more positive. Price still finding resistance around 480, this range area. So I think if price is able to break above 480, we should see some slight further recovery upwards to test the next resistance level closer to $5 over here. And then for Seatrium, it's generally still quite range bound, but I think it's still rather a bit weak for now. Still finding resistance around 145 level. It tested 2 times recently, but price is still holding some support around 140 level. I think should be quite range bound, but I think we could see some slight downside, maybe towards a retest of the swing lows at 137 if 140 is unable to hold. Okay, then for Ford Motor, I think price should do some slight recovery because it went down towards around 940, 950, the support level. There was some rebound and price did some consolidation recently before breaking out around 1020. Today, I think we could see some recovery towards the next resistance level, probably around close to $11, and the next one probably close to 1150, even 61. So maybe some bounce for Ford in the near term. Then Yangzijiang still a good buy. Okay, I'll do a T on Yangzijiang. Okay, for Yangzijiang Shipbuilding, I think currently looks like a double top around 273. Finding resistance, and price is still currently pulling back. First level of support is around 250, where previously was a range resistance as well as this level, this horizontal resistance level. So first level of support 250. Next one is around 237, 238. So I think for now probably still some pullback until we see like some bullish candles start to come in at some support levels. Then we could see some bounce. Yeah. Okay, will there be technical analysis to add? Yeah, so there's a live TA session tonight from 8 to 9:15 p.m. So feel free to join if you can join. Yeah, thanks. Then TA for sets. With sets, I think for now should be a bit range bound. Price is just consolidating with a bit of lower highs along the way. So then support should come in around this recent level around $3. So probably some consolidation for the time being for now. And resistance probably come in around close to the trend line around 320, 326. Okay, then for next one is Capital Corp, Franklin, CSE, and Next. Okay, for Capital Corp, I think price will see some bounce for now. As it still there's after finding support at around this 575, managed to recover back above this level at 585. So yeah, so I think we could see some further recovery towards next resistance level around 615. Yeah, then followed by around 630. Okay, then for Franklin, I think currently it looks like some consolidation after this bounce over here. So I think for now, if price unable to hold this 137 level, which was this prior swing high, some support over here. if it's unable to hold, it might go down slightly further down a bit towards 132, and then next support is around 127. So I think for now, probably some range bound with resistance still holding around 143, about there. Okay, then for CSE Global, I think for now should be some sideways consolidation as well. Recently coming back to the near this resistance around 48 cents. So maybe some slight pullback to just trade sideways with support coming in probably around 45 cents, 45.5 cents area. For MedTech, I think currently some price moving upwards after breaking out this downtrend resistance line. Also currently above this swing high resistance at 40.5 cents. So I think if could sustain this momentum upwards, next resistance, this key resistance level, it could test probably around 15.6 cents, this area over here, then followed by 60.5 cents. Yeah, so we could still see some a little bit more upside to test this next resistance level. Okay, then next one is on SIA. Okay, for SIA, I think some rebound after hitting this upper level at around 587. Currently, I think should be some range bound taking place because around 620 over there, there's some resistance from the past. And then short-term support should be around this 595 area. So I think price will just do a bit of consolidation for the time being. Yeah. I think that's all the questions for me now. I'll hand over back to my other colleagues to answer the other questions. Thanks.
Yeah, thanks, Zane. I'll take this question in the chat. So if you're holding NVIDIA, would you sell now or wait for results on 28 August or the projected first rate cut in September? Yeah, so the short answer is no, I wouldn't sell. Just hold on. If anything, over the last few weeks when the price dropped to below 100, probably bought a lot more, I guess in hindsight. But overall, the fundamentals continue to improve. I think commentary out from NVIDIA's customers are all very positive on I guess, spending more money on NVIDIA chips. So we should continue to see revenue grow, demand still be there, and obviously earnings grow as the higher, I guess the higher, more premium products have higher margins, and that's currently we see the demand at. So both growth on the top and bottom line, that should translate into, I guess, more share price gains. Obviously, we can't really predict the future, but likely we still think very healthy for NVIDIA, especially if you just take a look at AMD's results, which is kind of a proxy to NVIDIA. The ramp for its GPUs continue to be quite strong as well. Yeah. So hope that helps. I'll hand it over to Paul. Thank you.
Yeah, thanks, John. Just to add, if you think of NVIDIA, if you think of it holistically, I mean, their customers just said they're willing to buy NVIDIA chips, even though there's virtually no return on it. So it's probably the best to have such a customer. And you can imagine if Google just said that they're willing to buy and for strategic reasons and also meanwhile I'm just thinking which was Microsoft said they still don't have enough capacity for NVIDIA chips. So you can imagine what about the competitors like Amazon, Meta? They're not going to let their competitors, the big tech, take the lead in AI. So I think everyone's just going to scramble and just buy as much AI chips as they can. We're not saying that it's a positive thing. It's probably a bubble coming up there, but I think in the near term, the demand is there is probably going to be very strong demand in the near term because, like I said, returns doesn't seem to be an issue when buying this. The most important is probably to take the lead in AI. Let me move on to the other questions. Any idea when nanofilm? We're not too sure. I think second half could happen. So for nanofilm, they are very reliant on the customer Z, which is the largest smartphone maker in the world based in US. I think we know who that is. So unless you get this huge spike in demand for Apple phones, I think Nano will face quite challenging conditions. They have a new customer, but I think the volumes are still thin. So maybe the second half could do better, but until I think Apple start to really rally, then in terms of unit sales, then I think it's going to be sluggish. Helena, what's your expectations as well? I forgot for unit sales for Apple in 2024. Yeah, if you could just. Okay. Okay, let me move on. For Keppel, please comment on Keppel and its target price. So Keppel, our target price is 760. I think operationally it's not that exciting, but I think you really just have to depend on, like we mentioned before, monetization of their REITco and Flotel assets. I think near term is weak because second half they will be hit by property sales, because last year the weakness you see in their earnings is because they're not recognizing much property development sales from China especially, and there are not many more projects in Singapore. Do you expect government to release more land 2025? PropNex dividends growth retained. Oh, okay, so I'm not too sure the government's going to release, but the release of the recent land bids actually make the developers worry, because the pricing has been low. So developers are also rushing to launch because they're beginning to see the land bid prices start to come off. So that means the competitors now have the new bids now have a more competitive price than from them. I haven't done the actual numbers, but that's what the feedback is. PropNex growth, yeah, we think they can retain. They probably can give a 7% yield or maybe 8% this year. Next year will be more unique. So next year is PropNex 25th anniversary. And they always mention they will give a special dividend in special occasions, and probably 25th anniversary is considered a special occasion. So I think next year we could have a special dividend. Okay, for Hong Kong stocks, yeah, sorry, we don't have actually do much Hong Kong stocks. Sorry, many US and okay, still a lot. I don't think I can answer every single one. Let me just take the I would like to find out whether the recent market meltdown due to yen carry trade unwinding was over, as the market has recovered quickly. The concern of US will haunt the market again. Okay, so my own view is if there's a real unwinding, then I think the Japanese yen will probably go back, will probably jump 30-40%. So I don't think the whole unwinding actually happened, probably because unwinding is like an Asian financial crisis. All the bets that you make go back to square one. So a real unwinding by definition should have a really much more drastic thing, because probably the Japanese yen to US could drop back to maybe 110, 120. I'm not sure what's the level number, 140. That is the real unwinding. We think it's unwind a little bit, but not fully. Although no one will have the actual data. We don't think there'll be a very deep recession in the US, but definitely a slowdown. I mean, all indicators point to a slowdown. So rather than plan your trades for recession, I think just plan for a sharp slowdown, which means interest rates will be coming down and so forth. Okay, I think there's still a lot more. I don't think I can hold back, do everything. What's driving Hong Leong Asia earnings? Interesting that the China segment. I'm not sure about the China. I didn't attend, but Yigman, do you recall what they said about their Yuchai? But for Hong Leong Asia, they're also like Pan United, they're benefiting from the growth in ready-mix concrete. That's one of their big business. Yeah. Is there light at the end of the tunnel for AEM? Soon, maybe not so soon. We will give an update next week on all the AEM, UMS, and Nano Film. We'll do the film on the ground because no time, insufficient time this month, this week. But for AEM, I think it looks. I know the week earnings is weak, but it looks promising in a sense. Timing, I'm not sure. Is that they are securing a lot of new customers. But we'll share more details next week when we do a proper film on the ground for everyone. I'll hand it back. Helena, do you know what was your Apple estimate for unit sales this year and probably next year? Okay, never mind. Yigban, you got any? Did they say anything on the Yuchai?
Yuchai is doing well at the China segment.
Did they say why? I'm not sure.
That one I have to go back and recall.
Okay, all right then. I'll do one last one on Yoma. Paul, can you share a view on Yoma Lotus development search and all that? Okay, so actually for Yoma these days they are not willing to comment much on search. Although because search is technically not on the board directors, was not involved in operations for quite some time. So you won't see Yoma commenting on search, but of course we all know search is the shareholder owner and also Secret Links. But so far there hasn't been any officially any what do you call it, charges filed on him. But I mean it's just a very high risk bet of anyone taking. That's the only thing I can say, because Yoma themselves can't comment on search, so it's a bit hard for me to say. But of course, it's a bit worrying that these things have flared up and there's no official comment by the company on them. So I'm really not sure how to comment on this particular thing. But in general, we don't see the conditions in Yoma improving. The political. The only one positive is that the China Foreign Ministry was there, and they just mentioned that a Communist Party said that they want to see some elections happening. So for me, I thought that was a good sign that they want that even China is giving their thoughts that they should have some election going on, which will be the biggest catalyst for them if there is one that happens. With that, I think hard for me to comment much because most of them is speculation. Thanks. Sorry, I can't really much because the company also can't really comment much. With that, I'd like to thank everyone for your time. We really hit the 1 o'clock. Sorry to exceed it. We try to do a hard start at 1 p.m. And thanks everyone for your questions, and hope to see you again next week. And I wish everyone have a wonderful week ahead. Thank you, everybody.